Hello everyone, and thank you for joining our Your Overseas Home webinar today. My name is Roseanne Bradley. I'm a senior copywriter at Your Overseas Home. Today we'll be chatting with John Diking from Chase Buchanan about financial considerations you should have about when moving to Spain. It's great to have so many of you with us today, whether you're joining us live or watching on demand. Once John has finished his presentation, we'll open the floor up to questions. If you have any as we go along, please do pop your question in the bar on the right, and I'll ask them on your behalf. So John, it'd be great if you could start by giving us a quick introduction to who you are and what Chase Buchanan do before we get into your presentation.
Yeah, good afternoon, everyone. So I work as a private wealth manager for Chase Buchanan. I'm based in Marbella. I'm a Swedish national. I've lived in Spain for over 21 years. And for most of this time, I've helped expatriates with their financial planning. So basically, I have a number of clients that I look after the family finances, making sure that their arrangements are structured in the right way in Spain for tax efficiency, for capital growth, to receive an attractive retirement income, etc. So I help people with their investments and pensions down here in Spain, and quite often we help people in the transition period before they move to Spain, so they can look at things before they become Spanish tax residents, because sometimes it can be a bit too late once you've already become a resident here.
Fab. And can you tell us about the tax year in Spain?
Yeah, absolutely. Spanish tax rules and the tax year is very different from the UK. In the UK, the tax year goes from 6th of April to the 5th of April, whilst in Spain, it's the same as a calendar year, going from the 1st of Jan to the 31st of December. I think what's important to highlight regarding the Spanish system is that there are different regions in Spain that are autonomous. So the tax laws are different in these regions. So I live in the south of Spain, and Andalusia is the largest region. The rules here are, for example, different from the ones in Madrid and Alicante. So many people ask themselves, when do I become a tax resident in Spain? So the generic rule is that you become a tax resident in Spain if you spend at least 183 days in Spain in any calendar year. That's the main rule that applies in most cases, but when there are any cases where it's not clear cut, then you look at where's the center of your economic interest. And if your spouse is resident in Spain, then the Spanish authorities will by default assess you as being a Spanish resident as well.
Thanks. And what are your fiscal obligations if you're a Spanish tax resident?
Right, so once you become a Spanish tax resident, you'll be liable to pay Spanish tax on income from all your sources worldwide. So it means that whether you have buy-to-let properties in the UK or other countries, or investments in other countries, but you receive an income as a Spanish resident, then all those incomes will be assessed for Spanish tax. So you'll be liable for income tax on your worldwide earnings, capital gains tax if you have investments and have gains on selling investments or selling buy-to-let properties, for example. You may be liable for wealth tax depending on the region where you live in Spain, because it's been abolished in some of the regions recently. And you be liable to complete a report about your assets abroad, which is called Monella 720. And also, if you pass away in Spain, and if one of the beneficiaries of your wealth lives in Spain, or if someone inherits Spanish-sided assets from you, then those assets will be assessed against Spanish inheritance tax as well.
And income tax, is this payable on worldwide income or just in Spain?
Yeah, so you'd be liable for income tax on any sources of income worldwide. And the income tax in Spain depends on which region you're tax resident in, but it's pretty similar in most regions. So we'll look at the scale on the next slide. But yeah, what's important to highlight here, I think, is that you are liable to make this declaration by the 30th of June in the following tax year. So, for example, for any income that I earn in 2023, I need to make sure that my accountant sends in my tax return for my income between April and end of June next year. And sorry.
I'll let you go.
Yeah, so this is a slide that shows the tax rates in Andalusia, which is the region I live in, the largest region. And, you know, it may be a bit different in other regions, but it's not going to differ a lot. So you can see that the tax rates start at 19% and they go up to 47%, but only on really large incomes it goes that high. But it gets pretty steep. When it goes above 60,000 euros, that's when the rate is 45%. So as an example, if someone has a retirement income or pensions adding up to about 30,000 euros, after personal allowances, the tax rate, the effective tax rate will be in the region of 20%.
And then in for capital gains, is that the same kind of rates?
No, as you can see on this slide, the rates for capital gains are much more attractive than for income from work and pensions. So capital gains tax or savings tax, as it's called in Spain, it applies to interest from bank accounts, dividends from shares, or dividends from it can be from a unit funds, or if you sell a property, especially if it's a second home buy to let, then you're liable for this tax. So if it's up to 6,000 euros, then the rate is 19%, and then you can see that it goes up depending on the amount of gain that you have in the year. And these rates are personal. So if you have, for example, investments held jointly as a couple, then it's up to 12,000 euros you can have in gain and be taxed at 19%.
And is that this income rate tax, is this the same for wealth tax?
No, so wealth tax is a separate tax to the previous taxes we discussed. So wealth tax is quite unique to Spain. There are not many countries in the world that have wealth tax. So it's a tax on your wealth, and it's taxed on your net assets after deducting liabilities. So this wealth tax, it doesn't apply in all regions. It used to apply in most regions except Madrid, but last year it was abolished, practically abolished by Andalusia, and then Murcia followed suit, which is also here in the south. And but you still pay wealth tax in regions like Alicante, for example, which is a big region for expats. They are still liable to pay wealth tax, and this is something that applies on assets over 700,000 euros because you have a personal allowance up to that figure. And also, if you own a property in Spain, which is your main home, then you get an allowance of 300,000 per person. So these are the general rates. There may be some exceptions. For example, in Alicante, the general personal allowance is only 500,000. But the general rates means that a couple that have about 1.4 million in assets and 600,000 euro Spanish property, they may not be liable to this wealth tax at all. Right, and what we see here is national solidarity tax. So this is a new tax that was brought in towards the end of last year. And it's another wealth tax, but it applies on higher thresholds. So it applies on assets net wealth over 3 million, and the exemptions, the personal allowances are the same as the normal wealth tax. So it's normally 700,000 general and 300,000 on the property, and this is all per person. So it means that a couple with 8 million euros in assets may not be liable for this tax at all. And this tax applies in some of the regions that abolished wealth tax last year. So this still applies in Andalusia, for example, and Madrid and Murcia. And also, sorry, I forgot to mention one thing, if you don't mind going back a slide, Roseanne, that any liability for wealth tax at a lower thresholds, you get credit for when you calculate this tax. So you're not going to pay two types of wealth taxes. This is just one that starts applying at a higher level. Right, and another thing worth mentioning is Modelo 720, which is I mentioned at the beginning. It's a report about your assets abroad. So when you have cash held in bank accounts or investments or properties abroad, as soon as any of those three asset classes are worth more than 50,000 euros, then you need to declare those assets in the report. So for example, if I have UK bank accounts with three different banks and I have, let's say, £20,000 in each bank, that's £60,000 in total, I will need to declare those accounts in this report because it's more than 50,000 euros in total. And this is reported on an individual basis for the full value of the asset. So for example, if I have a UK property worth, let's say 200,000 jointly with my wife, then each one of us needs to declare the 200,000 on this report. But it's worth mentioning that this is only a report for information purposes. It's not an extra tax.
And would that apply to, say, if I'm a Spanish resident and I have capital gains from an investment?
Right. So if you have an investment that's worth over 50,000 euros abroad, then this goes on this report. But the actual capital gains are not reported here because they're reported on, as capital gains in your income tax return.
And is that the same for inheritance tax and gift tax?
Yeah. So inheritance tax is something that will be assessed here in Spain if you pass away and any of your assets go to another Spanish resident, or if you pass on your Spanish assets to anyone in the world. So for example, if I own a Spanish property and I have children in the UK, then when I die and if assets go to my children, then any Spanish assets will be assessed on Spanish inheritance tax. But if I have a bank account in France and they live in the UK, my children, then there will be no assessment for Spanish inheritance tax. So I think it's important to point out that this tax works very different from the UK because in the UK, you have something called an estate, and the state has a nil rate band of £325,000 per person, which is the tax exemption. And then normally anything above any nil rate bands available, you can also have a residential nil rate band for property. But once you deducted the nil rate bands, you taxed at 40% on the state. Whilst in Spain, this tax is worked out on the individual that receives the inheritance. So for example, here in Andalusia, there are rules which say that if you pass on assets to your spouse or to a child or a grandchild, then each one of those beneficiaries have a 1 million euro allowance. So it's only if you receive more than 1 million that it's going to be assessed on tax, and there are further tax benefits for inheritances above 1 million. But the general rule is that in most regions there would be some kind of tax payable even between spouses and down to children, but most regions have some kind of tax allowances or credits. So the way the Spanish system works is that the closer the relationship, like down the bloodline or to your spouse, you normally have more benefits. And the more distant relatives you pass on your wealth to, or if you pass it on to a friend, which can apply, for example, for people that have no children, or people that have stepchildren and want access to the stepchildren, they got to be really careful because those beneficiaries can attract a lot of, they can attract inheritance tax at high rates. So it's important to plan things ahead if that's your situation.
Yeah, definitely. Where you said it's a sliding scale, does that mean depending on the amount, it will have a different rate of tax?
Yeah, that's right. The higher amount you inherit, the higher tax you pay. So, but it also depends on the relationship that you have with the person that receives the assets. So, as I mentioned earlier, if it's a close relationship, the tax will be less. If it's a distant relationship, the tax will be more because the rates you see here, they're multiplied by a factor depending on the relationship. So, if you don't mind moving slides. You can see that beneficiaries in group 1 and 2, which are spouses, children, and grandchildren, they multiply the rates by 1, whilst groups 3 and 4, which are more distant, so it can be nieces, nephews, siblings, for example, they multiply by 1.5 or 1.9. So the rates can go up quite high in some Spanish regions. They can go above 80% if you pass on all your assets to your friend. So that's why it's again very important to plan things ahead. There are ways to switch assets around and set up structures to reduce this tax on death.
Would say you're in a couple but you're unmarried, would that does that get a bit complicated? Are you
Yeah,
automatically in group? Yeah.
yeah, and if I get clients that they're not married, I say get married straight away because that really helps. If you're married, then you get lots of benefits and allowances, both on the income tax side of things and as well as getting protection when you inherit because you normally get much better allowances. If you're a couple living together, not registered anywhere, just living together, then that such a couple will be treated as very distant. That they don't benefit from any tax credit at all on inheritance. So in Spain, you can either marry if you want to get this protection, or you can register as a civil partnership in Spain, but it's got to be the Spanish type of civil partnership, which is called pareja de hecho in Spanish. So if a client has already registered a civil partnership in the UK, for example, I would normally recommend that they make sure that they also qualify as pareja de hecho to avoid any problems in the future.
That's good to know. And in terms of wills,
Yeah, so I think it's important to understand when you set up a will in Spain. So perhaps once you come down here, once you bought a property, you want to make sure that the property is covered on the Spanish will or any other assets you have in Spain. I normally recommend that you set up wills in every country where you have assets. But it's important to understand that the Spanish system, which is, Spain operates civil law, while the UK has common law. So, there's something called forced heirship in Spain, which means that when you pass away, the majority of your assets have to go to your children by force. And many of my clients, that's not what they want to happen. They want everything to go to the surviving spouse on first death, and then they want the children to benefit on second death. So that isn't compatible with Spanish rules. So what people can do in this situation is that when they go to a Spanish notary and set up their will, they can say that for distribution of assets, they want the law of their nationality to apply. For example, for British nationals, there's total freedom of distribution. So the British national can decide who they want their assets to be passed to and in what percentages. So as long as you tell the notary, they will include a clause in your will, and this will be respected because this is part of like a European law, which is called Brussels 4, came in a few years ago, and it says that people's nationality should be respected for this purpose, and this is something that applies in spite of Brexit for UK nationals. And it's important to point out that this is only a law that allows you to freely dispose of assets on death. It's got nothing to do with inheritance tax. So Spanish rules will still be applied on Spanish assets. You can't do anything about that.
Okay. I always ask this question. Do you have any pitfalls to avoid for buyers in Spain?
Yeah. Do you mind switching slides? Yeah. Thanks. Yeah. I mean, quite a few things to consider when you move down to Spain, especially from the UK, because the tax and legal systems are so different. So I've got a few points here, some of the main ones. So be aware that UK tax-free savings products such as ISAs, national savings and income, premium bonds, etc., they're not tax-free here. They are fully taxable in Spain. So if you have, for example, an investment ISA, stocks and shares ISA, where you get dividends from your investments, or if you buy and sell investments inside the ISA, then there's no tax wrapper for that in Spain. So that's any gains you have on the investments when you buy and sell, or any dividends you receive are taxed in Spain on an ongoing basis on your savings tax rates. So just be mindful of that. And also, Spain can impose very hefty tax rates on offshore bonds. So be mindful of that as well. If you have any bonds that you've set up which are offshore, then you should review them before you move down to Spain. And also, if you sell a UK property, you may be liable for tax in Spain on the property sale. This gets a bit complex because this scenario will it will depend on your exact circumstances whether you pay a tax or not. But as a general rule, I do recommend that if you are moving down to Spain, you should sell your UK main residence in the tax year prior to the year that you become a tax resident in Spain. So, for example, if I have a UK property, I'm a UK resident now. I put it on the market right now, and let's say I sell the property in July. And I come down to Spain by the end of July, and I haven't spent much time in Spain, I can stay in Spain for the rest of the year. And as long as I don't spend more than 183 days in Spain this year, I'm not going to be considered a Spanish tax resident. So my first day of tax residence in Spain will be from the 1st of January 2024. And Spanish authorities will only assess capital gains tax on any transactions from the 1st of January 2024. So the UK property that was sold in July 2023 will not be assessed for Spanish tax. And there are scenarios when people didn't manage to sell the UK property and they sell it in Spain as Spanish residents. And there may be some exemptions and allowances, especially for people over 65. So it's something that we could discuss on a case-by-case basis. But as a general rule of thumb, it's much better to sell before you move to Spain, before you become a Spanish tax resident. Other pitfalls to avoid. Oh, sorry, do you mind just, yeah, thanks.
Sorry.
If you have no problem, no, sorry. If you have a pension in the UK, most people are aware that, if you're about to retire, you can take a pension commencement lump sum at some point. And if you haven't taken it yet, it's usually a very good idea to draw it down fully because it's tax-free. So you can take 25% of your pension tax-free in the UK. Because when you become a Spanish tax resident, and if you draw a lump sum from your pension at that point, you will be taxed on that as an income from pensions, which we looked at. The marginal rates can go from 19 to 47% generally. So, if you take a lump sum, you go up to higher rates. It can be a very high tax that you could totally avoid by drawing the pension commencement lump sum whilst you're still a UK resident. And another final point I'd like to point out, in the U. Sorry, please go back if you don't mind. Thanks, Roseanne. So Spain doesn't recognize trust. So trust is something that is an Anglo-Saxon structure that is not very understood in Spain, because Spain operates, as I mentioned earlier, civil law. So I do have clients that come down with existing trust structures in place, or they've been advised by other advisors to set up trusts. They just don't work down here in Spain because Spanish authorities, because they don't recognize them, if you are the settler of the trust, like if you are the person who set up the trust, you're the one who gifted the assets into the trust, then Spanish authorities say that those are still your assets. So if I give, if I settle 100,000 euros into a trust, Spanish tax authorities say, no, that's still your money, John, and I then need to declare that money as my asset abroad, and any income generated from the asset, I need to also report to authorities and investment income. So that's why it's normally not a good idea to have trust here. It just costs a lot of money to keep up the structures and doesn't really give any tax benefit in Spain.
And finally, do you want to run through your checklist before we get to some questions?
Yeah, absolutely, Roseanne. So I think one of the first things you should do if you're considering moving down to Spain is to speak to a financial advisor, someone that is fully qualified, understands both the UK and Spanish systems well, and the local regulations, especially the local region that you're moving to. That is really, really important. And one of the reasons you should do it is because we discussed today the UK tax system is very different from the Spanish tax system. So it's important to review your assets to see if you need to make any changes, and you can potentially benefit from UK tax allowances and exemptions as a UK resident. And then when you come down to Spain, an advisor can help you out to make sure that any arrangements you set up are efficient in Spain. If you have a long-standing relationship with the UK advisor, some clients are reluctant to give that up, and they want to continue with that advice because they've been dealing with them for years. But just bear in mind that most UK advisors are no longer able to offer advice outside the UK because of Brexit. So if you tell your UK advisor that you moved down to Spain, most likely they will tell you that unfortunately they can't help you anymore. That's just another reason why you should speak to an advisor that can help you in Spain and understands the local regulations, which most UK advisors wouldn't know anyway because they advise in the UK, they don't understand the Spanish side of things. I think you should also be mindful if you sell, if you are going to sell your UK main residence, you should also speak with an advisor to make sure that you don't unwittingly sell it at the wrong time, so that you're not going to be paying Spanish gains tax on the sale. So there are a number of scenarios when you can be liable for tax in Spain, even if you sold in the UK and then moved down afterwards, but you moved down at the wrong time. So it's very important that you speak to an advisor so you don't get a surprise tax bill when you come down here. And also understand, that because the legal systems here is very different from the UK system, you get it buried in mind for your financial planning generally. Estate planning, for example, it will be impacted. Make sure that if you come down here with your partner, but you got children that will continue living in the UK, how can you make sure that on second death, they can benefit from your wealth, from your assets in a simple way? And, because Spanish probate process can be quite long. It can take several months for your children to benefit from your assets if they go through Spanish probate. There are, however, some structures which can be used for Spanish tax efficiency, where you can also pass on assets without need for Spanish probate. So it's something that could be discussed with a qualified advisor who understands the Spanish rules. Someone like myself, of course. So anyone that wants to, I've covered off very generic rules today, but every person is different. Everyone's got different financial circumstances, different types of investments, pensions. So I'm happy to offer a free complimentary review which can take about 1 hour, where I can talk about your particular requirements, and I can then see how what steps you need to take as an individual before you move down to Spain. As I said, this is totally complimentary, something that we offer clients of your overseas home. So feel free to reach out to me on the contact details you can find on the screen. If you like to schedule a Microsoft Teams video call so that we can have a chat, and there's absolutely no obligation to proceed with anything, but I may recommend some changes to your current arrangements for you to reflect on. So you got absolutely nothing to lose if you want to have a chat with myself, and I'm sure we can take away a lot of things, many things that you should consider before you move on. And ideally, you should do this about 3 months at least before you move on. So it gives you time to make any arrangements and take any relevant actions before you become a Spanish tax resident.
Thanks so much, John. That was really insightful. Some
Thank you,
great tips
Roseanne.
there as well.
Thank you so much.
If you're okay, just running over slightly, we've got quite a few questions. Are you happy for me to fire them at you?
Yeah, absolutely. Go ahead.
Michael asks, I have UK investments. If I keep them and move to Spain, can I transfer money from UK investments to Spanish bank without tax?
Right. So if you encash some of the investments and transfer the money to a Spanish bank, then you may be liable for Spanish gains tax on when you encash, because you may encash at the profit, which then will be assessed at savings tax rates, which we said goes from 19 to 28%. And then if you then reinvest the money with a Spanish bank, you may generate some interest to return on those investments, so that'll be taxable in Spain. So it's important to point out again, as we said earlier, that as a Spanish resident, you'll be liable for tax on your worldwide income. So whether you keep investments in the UK, whether you reinvest in Spain, as long as you get an income from your capital, you will be assessed for that income in Spain.
Fab, thank you. Our next question asks, is there a double tax agreement between the UK and Spain? If so, can you pay tax on your UK pension in the UK rather than when you get to Spain?
Yeah, so there is a double taxation agreement in place between Spain and the UK, which is designed to ensure that you don't pay the same tax twice. So the way it works is that if you are taxed in the UK at source, for example, on a UK pension, then when your accountant in Spain completes your Spanish tax return, you need to tell them that you've been taxed at source in the UK, and you will then get credit for the UK tax that has been paid on your Spanish tax return. And you would only pay tax in Spain if there's a difference. So if the Spanish tax is higher, you would then just pay some difference there. And if the Spanish tax is lower, you can't claim any tax at source from the UK back.
Thanks. Jane asks, does the Modelo 720 report include the value of NHS pensions?
NHS pensions. That's an employee pension which is not flexi access. So this report, you only need to report assets which are fully accessible to you, whilst such type of pensions wouldn't need to be reported on Modelo 720. No.
Simon asks, he's married and he's looking to buy a property for around 500,000 euros to get a golden visa. He's asking, is it more tax efficient to buy in a single name or a joint name?
I guess it depends on what plan Simon has for the property. I mean, if he buys it for a visa, it's going to be the main home, at least for the first few years. So it's difficult to answer that question. When it depends on his age as well, because if Simon at some point decides to sell his Spanish main home, and if he's over 65 when he sells it, and if he's had it for at least 3 years, then that sale will be tax-free. So any profit he made since he bought it will not be taxed in Spain. So that needs to be taken into account when you decide, if you buy joint names or sole name, and also for the Spanish golden visa, I think there's an impact. I'm not a visa expert myself, but I don't do visa applications on a day-to-day basis at all. But I think whether you buy in sole name or jointly will impact on the visa application process.
Okay. Fab. I think we've got time for one more question.
Yeah.
With regards to pensions, would the advice be to take them out early, i.e., if we were moving before retirement age, should we refer rather than leaving them to maturation?
So I assume the question is about whether they should start drawing on the pension.
Yeah, whether they should withdraw it early.
Right. So whether they should start taking an income, not withdraw the whole amount. Because if you have a flexi access pension like a SIP in the UK, and if you draw down a lump sum in Spain, that's not very efficient because you go up to the higher rates. And if you should try to take some income in the UK before you come to Spain, it depends on the amount you draw. Because in the UK, on pensions, you would have a personal allowance of around £12,000 roughly, and you can be taxed as a basic rate, pay a 20% higher rate, 40%, for example, whilst in Spain, the rates go from 19 to 47. So I can't really answer that question generically without knowing what type of income that you're looking to achieve. But the one thing I can tell you for sure about pensions is that you should take the 25% lump sum if you still have it available, because that's going to be tax-free in the UK and it will be taxed heavily in Spain. So that's something you should do without a doubt.
Fabulous. Thank you, John. Some grateful tips and insightful advice there. That is about all we have time for today. If you found this webinar useful, we'd really appreciate it if you left us a review on Trustpilot. You just type in your overseas home. And we strongly recommend that you get in touch with John and the team at Chase Buchanan directly, as he said, to discuss your individual requirements. We'll be in touch, I believe, in the next few days with the link to this webinar on demand and their details for you. So thanks again and happy property hunting in Spain. Bye-bye.
Thanks, Rosanna. Thanks to everyone. Bye. I appreciate your time.
Bye, thank you.
Thank you. Cheers.